Every financial crisis in history has started the same way. Every single one. Before the headlines scream recession, before the layoffs, before the panic in the stock market, there's a quiet moment when the smartest people in the room start whispering that something doesn't feel right. And right now, that whisper is getting louder. It's 2025, and I'm seeing the same signals that appeared before every major collapse. 2008, 2000, 1998, even 1929. Liquidity vanishing, banks hoarding cash, the plumbing of the global financial system tightening up like a noose. And the scariest part is happening again while everyone's distracted by politics, AI stocks, and crypto hype. Over the last few weeks, something strange started happening in global money markets. The invisible network that moves trillions of dollars between banks every day. The repo rate, the benchmark cost of borrowing cash overnight, suddenly spiked. Not by a few basis points, but by the most since 2020. That might sound small, but in the world of money markets, that's an earthquake. When rates jump like that, it means one thing. Banks don't trust each other. And when trust disappears, liquidity dries up, fast. The Federal Reserve has over $3.3 trillion sitting in its reverse repo facility, idle cash parked by money market funds that refuse to enter the private lending market, even though they could earn higher returns. Why? Because they're scared. They see something the public doesn't. If this sounds familiar, it's because we've been here before. In 2007, the same thing happened. Overnight lending froze, and within months, the world fell into the worst financial crisis since the Great Depression. Back then, everyone said, the system is fine. They were wrong. So what's causing it this time? Let's start with the foundation. Too much debt and not enough trust. Across America, corporate bankruptcies have surged nearly 45% since 2023, according to S&P Global. Consumer delinquencies on credit cards and auto loans are climbing to their highest levels in over a decade. Commercial real estate, once the safest corner of the lending market, is in freefall. Office vacancy rates in major US cities like San Francisco and Chicago have smashed through 25%, and nearly $900 billion in commercial real estate loans are set to mature by 2026, according to Morgan Stanley. Many of those loans were written when interest rates were near zero. Now they're over 5%. You can do the math. Those properties simply can't be refinanced without triggering massive losses. Blackstone, Brookfield, and even regional banks like New York Community Bancorp have already taken hits on office portfolios. The FDIC's own data shows that more than $700 billion of US bank exposure is tied to commercial real estate, much of it concentrated in small and mid-sized lenders. That's the same group that started collapsing during the regional banking scare of 2023. And then there's the global side. In Europe, liquidity stress is flashing red. Repo rates have spiked sharply since late summer, and institutions like BNP Paribas and Société Générale have quietly begun pulling back exposure to US dollar funding. Meanwhile, Japan, long the world's cheapest source of capital, is unraveling one of the biggest financial time bombs of all: the yen carry trade. For decades, investors borrowed cheap yen from the Bank of Japan and poured it into higher-yielding assets abroad. But after the BOJ shocked markets in 2024 by finally raising rates above zero for the first time in 17 years, that trade started to unwind violently. Billions are being pulled back, liquidity is vanishing, and global markets are feeling it. And it's not just hedge funds. Central banks are fighting each other in a silent liquidity war, each trying to keep their currency from collapsing while the dollar gets stronger. The US dollar index just touched its highest level in over a year, tightening conditions worldwide and forcing developing nations to scramble for dollar funding. That's the same setup we saw before the Asian financial crisis of 1997. I've watched this pattern unfold again and again. It always starts in the shadows. Banks quietly stop lending, credit spreads start widening, repo rates rise. And then, something breaks. A hedge fund blows up, a real estate trust defaults. A big lender admits it's reassessing exposure. It's like watching dominoes lean closer and closer together. We're already seeing the first ones fall. Earlier this year, Commercial Mortgage Alert reported over $38 billion in US commercial loans already in default or workout status. Consumer debt just crossed $17.6 trillion, and average credit card APRs have hit an all-time high of 22.8%, according to the Federal Reserve. Yet wages are stagnating, savings rates are near record lows, and inflation, though lower, is still eating away at disposable income. So when I see repo rates spike, it's not just a number. It's a warning, a sign that money, the oxygen of the global system, is starting to suffocate. What's terrifying is that the Fed's safety net doesn't seem to work anymore. Their standing repo facility, designed to inject cash when markets get tight, was tapped by financial institutions over $50 billion in a single day recently. Yet instead of calming markets, rates kept rising. It's the same paradox we saw in 2019. The Fed stepped in, but liquidity stress got worse. And what about the European Central Bank? They're facing their own nightmare. As inflation cools, Europe's economy is slowing fast. Germany, the region's industrial backbone, has been flirting with recession for over a year. The ECB is stuck. Cut rates and risk a weaker euro, or keep tightening and crush their already fragile banking sector. Either choice leads to pain. Then there's China, quietly exporting deflation. Factory prices there have fallen for more than a year straight. That puts pressure on global trade and corporate profits. Combine that with the collapse of property giants like Evergrande and Country Garden, and you have a ticking time bomb inside the world's second largest economy. All of these threads are connecting. Higher rates, tighter liquidity, collapsing collateral values, and history tells me what comes next. It's always the same sequence. First comes denial, then fear, then panic. I've learned that financial crises don't start with explosions, they start with silence. A small freeze in credit markets, a few temporary liquidity injections, politicians saying everything's fine. Then one morning something snaps. A bank run, a margin call, a black swan that was obvious in hindsight. We've already seen cracks. In 2023, Silicon Valley Bank and Signature Bank failed because they couldn't handle rising rates. Everyone said it was contained. A year later, commercial real estate is the new weak link, and funding markets are flashing orange again. When I overlay today's data on past crises, the parallels are eerie. Before 2008, interbank lending seized up. Before 2020, repo markets blew out. Before 1998, hedge funds leveraged to the ceiling started liquidating. And before every single one of them, central banks insisted everything was under control. But here's the uncomfortable truth. The central banks don't control the system anymore. They can influence sentiment, but not trust. They can print money, but they can't make banks lend it. The real power lies in the network of shadow banks, hedge funds, and offshore liquidity providers that decide, quietly, whether money flows or stops. That's why these warning signs matter. The repo spikes, the credit crunch, the collateral shortfalls. They're the heartbeat of the global economy. And right now, that heartbeat is irregular. We're at the same point we were in mid-2019, the calm before chaos. Back then, it was repo markets that cracked first. Then, within months, the entire world shut down. This time, it's commercial real estate and global liquidity. The next domino could be anything. A major European lender, a US regional bank, or a hedge fund that bet wrong on rates. I'm not saying this to scare you. I'm saying it because this is what always happens. It's the pattern that never changes. Liquidity dries up, leverage unravels, and the illusion of control fades. And every single time, it starts quietly, right where we are now. So if history rhymes, and it always does, the next few months could be critical. Watch liquidity, watch repo markets, watch commercial real estate. Because by the time the headlines start screaming crisis, it'll already be too late. This is the part before the panic, the moment everyone ignores until they can't. And if there's one thing I've learned in every cycle, it's this. By the time people realize what's happening, the crisis isn't coming. It's already here.